Welcome to Sidebar, Bracewell's podcast devoted to government enforcement investigations, corporate compliance, and white-collar criminal defense. I'm Phil Bezanson.
And I'm Matthew Nielsen.
And we're your hosts and are both partners at Bracewell LLP, where we represent companies, boards of directors, and individuals in all manners of litigation, investigations, and enforcement actions. Matthew, do you want to introduce our guest today?
Phil, I'd be happy to. Today, we have an outstanding guest who is going to help us understand the world of cryptocurrency, which I can only imagine you have stocked away there in your recording bunker somewhere.
My virtual bunker. Virtual bunker with virtual currency.
That's right. To help us navigate through this world of crypto, as the kids call it, is our outstanding partner, Anne Termine. Anne has over 20 years of experience representing clients in investigations, enforcement actions, and litigation involving commodities, derivatives, and more recently, cryptocurrency markets. For more than a decade, she served as a chief trial attorney at the U.S. Commodity Futures Trading Commission's Division of Enforcement, where, among other accomplishments, she was the architect and manager of the CFTC enforcement program regarding the manipulation and false reporting of LIBOR. And fun fact, before joining the CFTC, she spent time in Orleans Parish, putting murderers and other bad guys away as an assistant district attorney. So don't mess with her. She's tough as they come.
At least that's what I tell my kids.
Welcome to Sidebar.
Thank you,
that's
guys. Right. Thank you. I'm very happy to be here. Thanks for having me.
Well, let's jump into it. And I'm going to need you to speak in small words and slowly for me. I'm not sure about Phil. He's in Seattle. He's hip to all the tech. But so what is cryptocurrency?
I'm not sure that's the right first question. I don't think it's about what is cryptocurrency, but how did cryptocurrency begin or come to be? And I think this is based on the concept of what is the Internet 3.0 or the decentralization of information. So just as the development of the Internet allowed us to connect with each other in wide and varied ways, it actually eventually became centralized by large players. So what was supposed to be decentralized access for the world became privatized. Data is being handled, controlled by a few big players rather than being freely exchanged. The internet literally sits on privately held servers. So blockchain, which is the technology underlying cryptocurrencies, is the concept to bring back the original internet, an open source for all. So it is a technology that allows people to interface and exchange ideas, transfer and track assets without the need to go through a third party. So blockchain is a technology that allows people to interface, to exchange ideas, transfer and track assets without the need to go through a third party. It is an online shared or distributed ledger that records every transaction on the internet. So compare this to banks or central banks who actually own the ledger for the movement of dollars. With digital assets, anyone who participates in this new internet has access to this ledger. How is this ledger created? Well, it's done by problem solvers, people who verify and extend the blockchain by solving complex computational problems. It creates then a different internet where it's connecting peer-to-peer and verified in terms of those transactions. So you can always add to the internet, you can always add to the ledger, but you can't erase from it. And how is a ledger created? Again, it's by mining. Those are the people who are actually solving these complex computational problems. And as they solve the problems, they earn a coin, in this case, a Bitcoin or Ethereum. So it's a way of creating a different type of internet that's peer-to-peer as opposed to an internet that goes transacted back to a central server and then other people reach into the server to get the information they need and then go out to get what they want. Does that make sense? Or as much sense as I can possibly make of it?
Let me try to see if I get this, because it seems like there are two different components here. On the one hand, we're talking about a technical problem-solving component where there are machines or people or a combination of machines and people actually crunching numbers and doing work that exists in maybe bunkers like mine. I don't know. And
quite possibly, yes.
But separate from that, there is this currency. And I think where the layman runs into the first hurdle to understanding this is, how do you separate the currency from the number crunching such that even Matthew could have Bitcoin? Because Matthew is not doing complex computations.
How do you know that? You could never possibly know that. I'm doing it now.
We've seen your calculator, Matthew.
I am willing to believe that Matthew is not doing complex computations, yet Matthew could have a large virtual stack of Bitcoin. So how does one like Matthew get his hands on Bitcoin, and what does he do with it other than watch its sort of value fluctuate?
Yeah, I would think of it in layers. So think of blockchain as sort of the base layer upon which digital assets exist. So, the blockchain is an ever-evolving internet without the use of centralized servers, because everyone who participates in it, in a sense, is adding to the server power. No one controls it. No one owns it. And that's why it's a distributed ledger technology. And that opens the door for decentralized services and markets, one of which is cryptocurrencies. And again, as you solve that computational problem, you earn a coin. And that coin is considered to be a cryptocurrency. And that's a totally different place. That lays on top. It's one of the technology's benefits, so to speak. And there are thousands of different cryptocurrencies, because as the marketplace developed, and as the blockchain developed, people found different ways to solve and to utilize the network. So different offshoots from the original Bitcoin created. Ethereum is one. And these are peer-to-peer assets, digital assets that can be bought and sold. People have described to me Bitcoin as like a fancy calculator. It can do certain things, but it's limited in its use. Whereas Ethereum and the network, the blockchain that underlies Ethereum, is more like a smartphone with multiple applications. And you could do lots of different things with it, which is why it's more powerful. So, Phil, getting back to your question of what can we do with this? What are these things? Well, they are assets of some type. And I think it's based on the value put into it. The other important aspect is that cryptocurrencies are finite. So there's only a certain number of computational problems in the network that began as Bitcoin. So there are a finite number of coins you can earn, Bitcoins you can earn. Same thing with Ethereum. So that scarcity in itself has value. People desire them. And that's how marketplaces grow around them. So there's scarcity and then desirability that adds to the value. And that's how this all began.
So my again, a layperson interpretation of this perhaps is, normally currency is generated by countries. That's obviously not the case here, but something still has to be, in a sense, the mint that is printing this money or creating this money. It sounds like what you're saying is the Bitcoin network as it exists and as it may exist into the future is the digital resource that is generating the currency, that it's minting the coins. And as more problems get solved within this Bitcoin digital universe, more coins get minted. But at some point, the last problem will be solved, the last coin will be minted, and there will be this Bitcoin problem solved, intertwined network and a currency that exists that was created out of that network. And then there's the currency, and it's finite, and people can do, treat it as an asset of sorts, right?
That's exactly right. And I think that's a really good summary. And when you tie it back to the concept of no central banks, that was the whole point. It is a peer-to-peer network. It is an open source network. It is not centralized in any way. And I think that's what the concept underlying all cryptocurrencies are. It's the underlying network is the ability to extend the internet and the use of sharing data, sharing information without having to go through central counterparties. So on top of it is these coins that are achieved by solving these computational problems and extending the network. And then they could have value because the marketplace says they do. I mean, it's no different if you think about it from that concept. It really isn't any different than a commodity or a security. That's a discussion for another day as to whether it should be a commodity or security, but it's a concept. It has something that has value. And I think that value comes from both its scarcity and its desirability. And that's how exchanges develop around it.
I mean, it's just basically the modern day barter system, right? I mean, back in the old days, I had something of value and you had something of value and we would exchange those. And now, the way I try to understand this, and we're going to hit the surface here, right, is I'm going to give you something that we're going to, we're going to have a name on that currency. Bitcoin's the one everybody, of course, knows. But I'm going to give you some amount of Bitcoin in exchange for use of your free computing space, or if you've added to the blockchain, and that's really just the exchange of value. And and what I think we have a hard time understanding is that because our currency is all regulated by central governments or central agencies, we're just getting back to the old. I mean, this is really just a fancy way of getting back to the old barter system, right?
It's not a bad way to describe it. I mean, if the blockchain and the distributed ledger technology is Internet 3.0, then digital assets of different types of cryptocurrencies can consider to be money 2.0. So it is one way. When you start bringing in governments and the way they regulate, I think that's for a discussion, a whole different discussion for a different day. But it is a different way that's fast, easy, cheap, relatively safe to exchange value peer to peer. So from me to you without having to go through a third party. And that's where the markets arise. And that is the value within it that that's why when it's traded back and forth and because it has scarcity, that's why the value of Bitcoin goes up and down per day and has a little bit more volatility than a traditional asset like any commodity or security that you can think of. But that's how this creates, and that's how marketplace get created around it. So you can buy and sell from a big player like a Coinbase or Binance or Kraken, Gemini, et cetera, where you can go to companies that hold a whole bunch of these assets and you can buy and sell peer-to-peer to them. And they also operate exchanges where you can go into the exchange and buy and sell from each other. So it's really funny because it's decentralized finance that has an overlay of looking very traditional. Like those peer-to-peer networks that certain exchanges operate look a lot like a traditional foreign exchange network, a foreign exchange market, a Forex market. So it's a bit of the built-in irony on the crypto assets. They are something completely different. They're not one-to-one to fiats, but the way that sometimes they operate in the financial markets now today, they kind of look like what traditional assets look like in financial markets. It's a bit of an irony involved in them, but the volatility that they create is desirable by investors, I think. And I think that's another reason why they've come into play. Like I think back when I first was introduced to the concept of crypto assets, it was when I was back at the CFTC. These things were coming into the marketplace. We clearly saw that there was an interest and a desire for them. And the agency struggled to figure out, where do they fit? Do they fit in our regulatory lexicon? And eventually the CFTC took an action where they declared Bitcoin to be a commodity. And then, I think back into late 2016 or early 2017 when I began to do work with Coinbase. And Coinbase at that time was an up-and-coming technological company built out of and based in San Francisco. By the end of 2017, Bitcoin had risen from about $3,000, I think, the price of $3,000 in July to nearly $20,000 by December. And Coinbase had grown from this technological company in San Francisco to a multi-billion-dollar financial institution. And the financial world sat up and took notice. And you have massive exchanges like the Chicago Mercantile Exchange who jumped into the game and said, we need to have futures on these. People need to have the ability to hedge or speculate on the price of this underlying commodity. And it just the change in this marketplace has just been dramatic. And I think the growth in it is still there. You have now not only derivatives for Bitcoin, but you have derivatives futures for Ethereum as well. You have swaps that are being created, and a variety of different swaps, which are an advanced derivative type of derivative for these kind of products. You have people clamoring for exchange traded ETFs, for exchange traded funds, which would track the price of an index or a basket of these assets. But again, now we're starting to dip into the regulatory morass that comes from the creation of these assets. But the reality is, it is a new type of exchange of value that is based on an internet. And that is, it's still mind-boggling for me to understand it and to try to explain it to somebody. But clearly it's desirable and people want it. And that's why you have all these different coins developing, you have the blockchain expanding, and you have different uses for it developing on a day-by-day basis.
There's a lot in there that you just went through. And one of the kind of threads that I want to pull on a little bit is the first step into cryptocurrency going from something generated as part of a blockchain development project into something that's now in the hands of investors, marketplace participants, speculators who have almost nothing to do with the actual mining of the cryptocurrency. That this cryptocurrency almost has two lives. It exists first as the reward for doing the complex computations, but then through buying and selling, winds up into this sort of investment asset or currency or commodity, depending on what your perspective is. So how has this thing come to market? That is, how does it become something that lay people who are not crunching numbers start getting their hands on and looking for things like, hedges and swaps and bundling and that sort of thing?
Most of the money, I think, in crypto assets today still lies in the buying and selling of the assets themselves. So if that's what you're interested in, if you're interested in just exploring and trying to determine whether or not you want to buy this new asset, then you could go to any one of those exchanges, and there's a whole ton of others, crypto.com, FTX, in addition to the ones that I mentioned previously, where you can go to people who already have the assets and you can say, hey, I'd like to buy, I don't know if anybody can afford a Bitcoin right now, but, or I'd like to buy some Cardano or Ethereum or Litecoin. These are all the other altcoins, as they're called. So these other networks that developed off of the back of the original network, that being Bitcoin. So you can pay money and you can buy it and you can hold it. There's a whole nother concept to this that we haven't really got into, and again, I think there's so many complexities to this that it would take too long and more than 30 minutes and for us to even get into, but there's ways to hold it. There's keys on how you keep it private. And this is all about the distributed ledger technology, because every time we buy, sell, or move the Bitcoin in any way, it gets written to the blockchain. So it's there, it's proven, it's verifiable, and it can never be changed. And that's the concept of that distributed ledger as opposed to a bank, for example. So if you and I wanted to buy or sell or exchange money in any way, I need to send you money, we would do it through a Venmo or PayPal or Bank of America through Zelle. And the ledger for that transaction is held by the banks. Whereas here, the ledger is held publicly on that open source network. Open source network.
And open to everybody.
Exactly.
Yeah, it's a thing that's kind of crazy, right? You start thinking about, like you just said, like, wait a minute, my essentially bank statement would be public. I mean, and with regard to this particular, asset, that's exactly what happens, right? And that's, I think, part of the appeal, I guess, is for people to think that there's some safety in that, and that you can't mess with the blockchain, right? That's why I guess they call it the blockchain, because if you mess with it, you break the chain. And therefore they're recording these transactions, and it can be verified by everybody, and everybody can see that. Of course, then, like you said, you get into private, secured keys as far as like holding the actual asset. But it just is such an interesting, different way of thinking about, and we call it currency, and so that's a whole nother issue, right? That we can get into.
Absolutely.
Is it currency, or is it or is it some other form of asset? Because of the pretty substantial volatility that's associated with it that we don't necessarily, at least those of us in the United States, don't think of, right? Because the dollar doesn't have this great volatility like some other currencies in other countries.
Yeah, I think that's where it's hard to wrap your head around it because it's not a fiat, and that's the beauty in it as well. You say that your entire bank account is on the blockchain. Well, not necessarily. Just what assets do you own in Bitcoin or on the blockchain? And actually, it's not necessarily tied to you. It's tied to your key, and that's a whole different. But you also have portability. Because those assets aren't tied to a financial institution or controlled by a central bank, you can go anywhere in the world and access those assets. And that is why there is beauty in that decentralized network, or at least that's one of the underpinning values to this technology and the growth in the crypto assets. It's also secure because it's tied to a specific key. Your key for those assets. And it's verifiable. So therefore you can always track it. Nobody can steal it. I don't want to say it's completely less hackable because then we're getting into a level of computing technology that is far beyond what a lawyer, particularly an enforcement lawyer, should be getting into. But that is the underlying concept and value within this decentralized network. The use of these assets, that's debatable, as we said, Matthew, and people can find different ways to think about using them. And that's still being explored. And that's because this is an ever evolving industry. There are businesses that will take coin like Bitcoin in exchange for a cup of coffee. But that always comes with a different type of transaction value. So you're exchanging a piece of your Bitcoin that you bought for a $5 cup of coffee, a fiat $5 cup of coffee. And now you've got to figure out, what did I pay for the Bitcoin to give them $5? So how much Bitcoin do I give them? What was the change in value from when I bought the Bitcoin to when I'm transacting it into Starbucks? And of course, because the one government agency who has absolute certainty on how to handle these things, that being the IRS, there is a capital gains or loss on that transaction that you are then going to have to report on your taxes. But again, I'm getting into a level of detail that's probably not worth it for this conversation. But there is value there. And then you have other versions of this that are being explored, like stable coins. So rather than calling it a coin that you've earned because you've extended the blockchain, there are coins that are tied to actual fiat. So 1-to-1 for US dollar, for example. And the companies that offer those have to have in their hand the right kind of fiat to be able to exchange that digital coin, that stable coin, for the fiat eventually. Then you have a different extension to that, which are central bank digital coins, so CBDCs, which are being developed and explored and even being discussed here in the US, which are the digitization of a central currency like a US dollar. China is probably the most advanced with this. So think about it from that perspective. If your fiat can also be utilized as a digital asset as opposed to paper money, it can also be tracked. And it can be tracked publicly. So when you go and buy that Starbucks coffee for $5, not only will you know, but not only will the network know, but so will the government. So there's some other interesting concepts within that. But these are different ways that the technology is being explored and utilized. The Ethereum network offers a whole bunch of different other values. Smart contracts, we could use the technology to track our inventory because we can digitize our inventory, for example. And then when we buy or sell the inventory, we can track it in a very simplified way on the blockchain, on the distributed ledger technology. That has a lot of interesting use aspects to it that companies are exploring. And because it's instantaneous. There's no question on what happened there. And it's verifiable. Then we can also get into things as the industry develops into something like non-fungible tokens, which are basically a digitized version of something with value, like a piece of art or a play in a football game. Right. And because these can be tracked, they're almost like saying it's a way to track the authenticity of a player's baseball card, for example. And this is just the explosion of NFTs, as they're known, is tremendous. I mean, if I look back to where they were a year ago to how many exchanges there are today, it's ridiculous. And now you even have the NFL jumping in on them. But that's because the technology is so desirable, because it is so open source, because it is so varied, there's so many different ways it can be used. And these markets are constantly evolving. And the use on them, it's so creative. It's absolutely wonderful to watch the innovation here. And then that leads to the discussion of what does it mean from a regulatory point of view. And again, that's a morass for another day.
So maybe as a bridge to our part 2 discussion about the regulatory environment, which will be again a separate discussion on a different day. I'd like to ask a little bit about ICOs, initial coin offerings, because that's sort of the bridge. I view it as the bridge from crypto into really regulated stuff. And we don't have to talk about the regulations associated with ICOs, but if you can give us a thumbnail sort of summary of what an ICO is and how it fits into the sort of cryptocurrency world.
Wait a minute. Did I just hear, are we going to have our first part 2 guest? That's awesome.
Oh yeah. We definitely need a part 2 here.
Fantastic.
It took 30 minutes to just learn what this stuff is. And now we got to figure out how it actually fits in with enforcement investigations, white collar, and the law stuff that we do.
Fantastic.
So getting into ICOs is extremely complicated, and it actually opens up this whole other discussion we keep referencing, which is the role of regulation with respect to cryptocurrency and its underlying technology. And I think that's the complications there of, should these assets be regulated? And if so, by whom? And who gets to decide what they are when their whole underlying concept is to be open source and peer-to-peer and without tying to a government entity. And that's the problem. How do we take a traditional financial structure and overlay it on something that it is now a financial markets, but are so far evolved from where our regulations are? How do we do that? And that is what is being openly discussed, debated, argued today at the SEC, the CFTC, the Fed, the Treasury, OCC, and on the Hill, literally every day. I know there are legislation pieces that are being written in various committees, those that cover the CFTC, those that cover the SEC. And it's really difficult because the problem is that the development of this industry is far outpacing current regulations or the abilities for regulators to catch up. And at what point do we have the regulation? This is what the debate is happening, even within the regulators. How do we ensure that people who play in these markets are safe and that they know what they're doing and they're not going to be cheated? Because anytime you open up a marketplace, there will always be cheaters. I mean, Forex markets, metals markets, securities, penny stocks, all of them existed, and someone's going to take advantage of a customer if they can. But most of the players in those markets, just as they are in the cryptocurrency markets, are actually legitimate players who just want to make these things available and to have this open source network and this financial network available to all. So how do we make this fit within a regulatory structure? And that's what's being debated. And whether or not the regulators should do it in such a way to stifle the innovation that's happening or to provide guardrails so the innovation will happen, but not at the expense of the customers involved. And that is a really hard line to find, and what they're struggling with today. The concern is that if the U.S. regulations, the U.S. regulators become too overly involved, they will stifle the opportunities here in the U.S., and it will move offshore even more so than it already has, and the rest of the world will leave us behind. One example of that is the CBDCs, the central bank digital assets, digital coins that we talked about earlier. The fact that, the Sweden and China, European Union are probably much farther beyond than where the U.S. is on this concept gives you an idea of how quickly we can be left behind. But getting into the debates that are happening, they're absolutely fascinating and they change daily. But it's to me, as someone who is a former regulator and now operates in the space to help those legitimate businesses continue to innovate and offer products safely to customers, it's absolutely fascinating and something I have to watch almost on a minute-by-minute basis.
Well, that's a great place to leave it, and we'll try to tackle that more complicated issue on our next episode with you.
Sounds good to me.
All right. Well, thank you, Anne, for joining us today. This has been a really great, thorough primer for both of us, for Matthew and for me. And thank you, thank you, audience, for downloading. You can always find episodes of Sidebar at bracewell.com or anywhere else you get your podcasts. Thanks very much. Bye-bye.
Thanks, Anne.
Thank you, guys.